Welcome back to Investing Talk Podcast.
Today we're looking at Opendoor Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show.
We really have a pretty fascinating situation on our hands today. We are doing a deep dive into the Q4 FY 2025 earnings review for Opendoor.
Yeah.
And honestly, if you only looked at the market reaction on February 20, 2026, without actually reading the report, you would think this company just announced they found a literal gold mine underneath their corporate headquarters.
Yeah, the pre-market action was crazy.
Exactly. The stock surged 17% in the free market, and it settled, roughly 7 to 11% higher after the dust finally settled. It was just a massive move.
Which is exactly why I need to jump in here and play the designated party pooper right out of the gate. Because I saw that surge too. It was violent. But when I actually popped the hood and looked at the engine, I mean, come on. Revenue is technically down 31.9% year over year. They completely missed their GAAP EPS targets. It feels like the market is throwing a ticker tape parade just because the house isn't burning down quite as fast as everyone thought it would.
That's a fair point.
So the core question we have to answer for you today is simple. Is this a legitimate turnaround story, or is this just the literal definition of a dead cat bounce?
And that is the absolute mission for this deep dive. We need to figure out if Opendoor's pivot, and I mean this massive strategic shift toward unit economics and AI-driven pricing, if that's actually working well enough to justify that price action. Because yes, the year-over-year numbers look really ugly if you just skim the surface, but there is a lot of nuance in the sequential data that suggests something fundamental has actually changed in the machine.
All right, I'm skeptical, but I'm listening. Let's dive into the fundamentals. Let's unpack the hard numbers first.
Let's do it. So, the headline number that got everyone so excited was the revenue beat. Opendoor reported Q4 revenue of $736 million. Now, to put that in perspective for you, the consensus estimates what Wall Street's brightest minds were expecting were sitting way down at $594 to $596 million.
Okay, so they beat estimates by roughly 23 to 25%. I'll give you that. In this macro environment, beating expectations by a full quarter is significant. It implies the analysts were just way off base regarding the company's ability to move inventory.
It does. But here's this specific statistic that I think actually drove the stock up, and it's one you really have to dig for in the report. They had 46% sequential growth in home purchases.
Just to clarify for everyone listening, when you say sequential, you mean quarter-over-quarter growth, not year-over-year.
Exactly. We're comparing Q4 directly to Q3. And that distinction matters immensely right now. This jump from Q3 to Q4, it basically proves that their new pricing algorithms are actually finding volume again. You have to remember, for a while there, the fear was that their algorithms had become so tight, so incredibly conservative to avoid taking losses on homes that they essentially couldn't buy anything.
Right, they were just lowballing everyone.
Exactly, lowballing everyone to stay safe. This 46% jump says we can buy homes and we can do it at our price point.
I see the argument. It's a pulse check. The patient is alive. But I have to contextualize that drop I mentioned earlier. Yes, buying is up compared to 3 months ago. But if you zoom out to a 3-year timeline, their revenue growth is negative 18.4%. The company is significantly smaller than it was 3 years ago. So are they actually growing, or are they just bouncing off the bottom of the ocean?
They are resizing for profitability. It's a purposeful shrink. Management realized the old model of growth at all costs was basically suicide in a high-rate environment. And that leads to the second key fundamental, which is margins. The adjusted EBIT loss narrowed to $43 million. Last year, that loss was $49 million.
Hold on. Narrowing by $6 million isn't exactly a moonshot. They are still losing $43 million in a single quarter on an EBITDA basis. And remember, adjusted EBITDA is often just corporate code for earnings before the bad stuff. It ignores stock-based compensation and a lot of very real costs.
That's totally fair. And you should always eye adjusted numbers with a healthy dose of suspicion. But look at the trend line of the contribution margin. Management explicitly noted that contribution margins bottomed out in September 2025, and they have been improving every single month since then.
For the listener who might not be an accountant, let's quickly clarify contribution margin. We're talking about the profit they make on the specific house itself, right? Before paying for the corporate headquarters, the software engineers, the marketing budget.
Precisely. It's the raw unit economics. Think of it this way. If Opendoor buys a house for $300,000, puts $10,000 of repairs into it, and sells it for $320,000, they have a positive contribution margin. If that number is negative, they are literally paying people to take houses from them. For a long while, that margin was dangerously thin or even negative. Now, they are targeting their highest exit rates, meaning the sales prices relative to their purchase prices since Q2 of 2024. That is a clear signal that the unit economics are getting healthy. They are actually making money on the houses again.
Okay, getting healthy and being profitable are two entirely different time zones, but I did notice the forward guidance regarding the timeline. They are guiding for break-even adjusted net income by the end of 2026.
Exactly. That is the light at the end of the tunnel. That is the carrot on the stick for Wall Street. Investors are completely willing to forgive the current bleeding, if and only if they believe the 2026 break-even story is mathematically real.
But to make it to 2026, you need to not run out of money in 2025. You can have the best plan in the world, but if the bank account hits zero, game over. So I checked the safety net. Financial health is, well, it's okay. They're currently holding $962 million in cash.
Which is a very substantial runway.
It is. Almost $1 billion in cash does buy you a lot of time, even with a $43 million quarterly burn. You can burn that for quite a while without panicking.
And remember, there are no dividends here. There are no share buybacks. Every single dollar of that cash is earmarked for reinvestment. It's for the AI-driven pivot. They're pouring resources into the platform to make sure that algorithmic pricing model is unbeatable.
Fair enough. But I also have to point out the leverage ratio is 3.3. That's manageable for now, but the debt is definitely present. It's like carrying a heavy backpack while trying to run a marathon. If the housing market takes another nosedive or interest rates suddenly spike again, that debt gets much heavier very quickly.
It's a real risk, sure. But that brings us to the moat. Why do we actually think they can survive a downturn better than a standard brokerage or a local flipper? It's the network effects of the iBuying platform.
The classic tech moat argument. Convince me. Because right now, Zillow is just a click away, and local real estate agents are very hungry for commission.
It's all about certainty and speed. Traditional agents simply cannot match the speed of Opendoor's proprietary pricing algorithms. In a volatile market, sellers value certainty above almost everything else. You want an offer, you get it instantly. You want to close, you pick the exact date. That user experience protects their market share against competitors who have largely backed away from direct buying. Opendoor is targeting those high exit rates, and they are seeing acquisition growth potential of 35% plus, precisely because they are the only real game in town for instant liquidity.
I'll admit the convenience factor is real. I've sold a house the old-fashioned way, and it's an absolute nightmare of open houses and flaky negotiations. But convenience doesn't always equal profit for the company providing it. However, I can't deny that the market seems to agree with you right now.
That's a perfect segue. Let's pivot to the charts and price action.
Yeah, looking at the technicals, this was a violent move upward, and I mean that in a good way for the bulls.
Massive volatility.
Yeah.
As we mentioned at the top, up 17% pre-market on February 20th. Even after the initial frenzy died down, holding a 7 to 11% gain for the session is incredibly impressive.
What stands out to me is the soaring action mentioned in the market coverage. It heavily suggests that the stock just blew right through historical resistance levels. Usually when a stock has been beaten down this long, I mean, we're talking down 90% from its highs a few years back, you have a massive graveyard of bag holders.
Right.
People who bought way higher and are just waiting to sell as soon as the price ticks up enough to let them break even. They normally create a hard ceiling on the price. But the stock cleared those levels effortlessly on heavy volume.
That's the absolute key here, the volume. High volume confirms the move. It tells us this wasn't just a few retail traders getting excited on a message board. This was heavy institutional flow, big money. And here is the narrative shift we are seeing. Investors are completely looking past the current operational losses. They are aggressively pricing in that 2026 break-even path we just talked about.
It's a psychological shift. You're seeing the big money investors say, okay, the worst is definitely behind us. The bleeding has stopped.
Exactly. Despite some neutral sentiment scores in the broader quantitative data, the actual money flow is undeniably bullish on this strategic progress. The market is voting with its wallet, and the wallet is wide open.
I have to admit, even as a hardened skeptic, seeing the price hold those gains despite the very confusing mixed signals in the earnings print, it shows strength. It shows a real baseline of belief. But let's see if everyone actually agrees. Moving on to market sentiment.
What's the word on the street right now? What are the financial headlines actually saying?
I'm reading the room here, and the headlines are a bit of a Rorschach test. You see whatever you want to see. On one hand, you have headlines screaming things like, "Why is Opendoor Technologies stock soaring?" and progress should continue. Those are clearly very bullish. They are focusing entirely on the revenue beat.
Right. They are focusing on the momentum and the sequential improvements in the purchase volume.
But then you have the bearish headlines focusing heavily on the guidance, which we will definitely get to in a minute. Headlines like, Opendoor sees Q1 sales miss. It's definitely a mixed bag out there.
What about the analysts? Usually, they are the first to change their tune when the fundamental wind shifts.
Not yet. And that's actually really interesting. UBS is retaining a neutral rating with a $5 price target. I haven't seen any massive upgrades yet for 2025 and beyond. It feels like the analyst community is firmly in wait-and-see mode. They've been burned by this specific stock before, and badly.
I would actually argue that 4 straight quarters of revenue beats suggest those analysts are lagging. That's a classic phenomenon on Wall Street. Analyst lag. They are usually very slow to upgrade until the trend is completely undeniable, mostly because they don't want to look foolish twice. It's much safer for their careers to stay neutral until the stock is already up 50%. I genuinely think we might see some major revisions coming soon if Opendoor can string together just one more solid quarter.
Maybe. But here is my biggest red flag in the sentiment bucket, and you know I check this metric every single time. Insider flow.
What are you seeing on the filings?
Absolutely nothing. That's the problem. There is no recent Form 4 cluster buying, no 13F accumulation showing that the big funds or the company insiders are actively loading the boat. If management is so incredibly confident about this 2026 break-even and they truly think the stock is dirt cheap right now, why aren't they buying shares with their own money?
That is a very fair point. You always want to see insiders eating their own cooking.
Exactly. When the CEO and the CFO are buying equity with their own personal checking accounts, I listen. That is the strongest signal there is in the market. When they are just talking about AI pivots on an earnings call but keeping their actual wallets closed, I get suspicious.
It's a highly valid caution. Actions speak much louder than conference calls. But let's look at the other side of the coin to balance this out. What could actually go wrong from here?
Let's look at the risks, because there are some major ones. This is definitely not a victory lap yet for anyone holding the stock.
The bear case. Lay it on me.
Risk number one, and this is major, the guidance miss. We spent a lot of time celebrating the Q4 beat, but the Q1 guidance was weak, like surprisingly weak. Management is guiding for $662 million in revenue for the next quarter. The consensus estimate, what the market actually expected to see, was $984 million.
That is definitely rough.
Rough is putting it mildly. That is a massive miss. They are guiding hundreds of millions of dollars below expectations for the very next quarter. That means the overall revenue shrinkage is absolutely not over yet.
Okay, I have to step in and defend this strategy. This goes directly back to the discipline argument we discussed. They aren't chasing bad volume anymore. If the housing market gets weird or interest rates are fluctuating or regional prices are unstable, they are purposefully choosing not to buy houses that won't make a solid profit. That $662 million is high-quality revenue, not just empty calories to pad the top line. They could very easily hit $1 billion if they wanted to blindly buy bad houses, but they are flatly refusing to do it. That discipline is actually incredibly bullish for the long-term viability of the company.
High-quality revenue doesn't pay the light bill if the overall volume is too low to cover your fixed costs. You have a massive corporate structure. If you only sell 3 houses, even if they are incredibly profitable houses, you can't pay the salaries of a huge workforce. There's a baseline floor where the business model mathematically breaks, and $662 million is getting uncomfortably close to that floor. And that leads directly to risk number 2, which is the macro headwinds. Overall, housing starts are down 5.8% year over year. The entire pie is getting smaller.
The macro environment is undeniably tough, no argument there. Higher mortgage rates, structurally lower inventory, it all naturally hurts transaction volume across the board. Opendoor inherently relies on churn. They need liquidity in the housing market. If the broader market freezes, their model freezes.
Yeah, and finally, risk number 3, the profitability reality check. GAAP EPS was a clear miss at negative $1.26, and the trailing 12-month net margin is still negative 6.72%. They were literally losing almost 7 cents on every single dollar of revenue over the last year. That is simply not a sustainable business model yet.
I concede the point entirely on the current margins. They are negative, no way to spend that. But again, that $962 million cash runway allows them to safely survive this transition period. They have the actual runway to fix the engine while the plane is in the air. They aren't going bankrupt tomorrow.
Time is money, literally, in this specific case.
I should also mention, there are some rumors floating around, and I really want to stress for you listening, these are unconfirmed. But there are rumors about new AI pricing tools and cash plus products in the pipeline.
Ah, the Wall Street rumor mill.
We have to at least mention it. There is deep speculation that these software products could drive lower capital growth, basically making money on transactions without having to actually buy and hold the physical house themselves, acting much more like a marketplace or a pure service provider.
Mm.
But to be clear, these are entirely speculative right now. They aren't current revenue drivers we can model.
Right. And I don't invest on rumors. I invest on hard numbers. And right now, the current numbers say cash burn and revenue decline, even if the sequential Q3 to Q4 story is a nice green shoot.
Well, we've looked at the good, the bad, and the distinctly ugly parts of the report. I think it's time to weigh it all up for the listener.
Let's move to the final verdict. What is your final score based on the research?
Putting it all together, the impressive revenue beat, the sequential growth returning, the massive cash position, and the very telling market reaction, I am personally assigning Opendoor a bullish score of 8 out of 10.
8 out of 10. That is an incredibly high score for a company currently losing money every quarter.
Here's the core thesis, the elevator pitch for you. The Q4 revenue beat, and crucially, the narrowing EBITDA losses, they validate that the algorithm overhaul is actually working. You simply cannot ignore 46% sequential growth in home purchases. That is the glaring signal in the noise. The massive stock surge proves that the market cares way more about the clear path to 2026 profitability than it cares about the current EPS miss. This is effectively a binary outcome stock right now.
Meaning what, exact?
Meaning, if they survive the current macro environment, the stock is a multi-backer from these current levels. It has been historically priced for bankruptcy. If bankruptcy is firmly off the table, the stock mathematically has to re-rate significantly higher. My strategic approach here would be a swing trade into the Q1 earnings report. But realistically, this sets up as a solid multi-year hold for that specific profitability inflection point. If they hit break-even in 2026, like management says, this stock is going to be significantly higher than it is today. So you're betting entirely on the trajectory, not the current location of the financials. Exactly. Successful investing is usually about figuring out where the puck is going, not where it is right this second.
Okay. I will offer a skeptic's concession here. I do agree that the underlying unit economics are turning. They certainly aren't bleeding out nearly as fast as they were 2 years ago. But I am going to firmly warn our listeners right now. Watch that Q1 revenue number incredibly closely. If they miss that lowered $662 million guidance, or if that sequential growth suddenly stalled out again, this stock could easily give back all of those recent gains very, very quickly. It is still walking a tightrope.
That's totally fair. It is absolutely a high-reward play, but it requires serious vigilance from anyone holding it.
It certainly does. Well, that wraps up our deep dive into Opendoor. It's definitely one to keep a very close eye on and keep on your watch list for the next few quarters.
Absolutely. Thanks for tuning in and going through the numbers with us.
Don't forget to subscribe, like, and comment to this video to support the show.